Good morning. Welcome to the Genghis Weekly Cross-Asset Strategy webinar. So today with us, we have Chachi Logutu, who is the head of research at Genghis Capital.
So I'll start as usual the macro, and then I get into the fixed income, and then my colleagues finish off with the equity segment. So the highlight for last week undoubtedly was the 2021 economic survey, which gave us the 2020 GDP numbers. A bit on the rear view mirror, but nonetheless, it was quite helpful in the sense that this data is part and parcel of some of putting as an input of asset allocation or whatever, just to see how 2020 was. So in terms of the overall real GDP, the print there was negative 0.3%, undoubtedly because of the COVID-19 fallout. It was acute in some of the sectors such as the tourism, that is accommodation and food services, which went down, I think, 48% year on year. Also transport and storage, and to an extent, the education sector. So those were some of the sectors that were negatively impacted just because of the containment measures that were in place last year. This negative 0.3% was against 5%, which was the revised 2019 real GDP number. Looking at the nominal GDP, so this is now the GDP at the current market prices. So for 2020, that was around 10.75 trillion against 10.26 trillion, the revised number for the previous year. So that is ideally the total value that was added in the economy in the year 2020. Obviously, that economic survey will be something, as I mentioned earlier, in the rearview mirror, only that it had at least some interesting bits to it, and that was the rebasing of the economy. Basically, now the rebasing now changed the base year from 2009 to 2016. And then looking at the 2019 nominal GDP, we saw that being revised to 10.26 trillion from a 9.74 trillion thereabouts that was there initially. So that was an increase of 5.3%. That was the impact that we saw translating because of the rebasing of the GDP. And we saw in terms of the sector-wise, agriculture predominantly one of the largest sector in the economy. Initially, it used to be like 33% on average, but right now in the revised environment, we are seeing it at 20% contribution in the overall GDP. I think the biggest increase that we saw was on the transport and storage sector. I think it moved a marginal 2% increase, majorly because of the contribution of other transport sectors, such as the land transportation. We've seen there's been an influx of boda. There's also been the digital platforms for taxis, which had not been factored in the previous GDP tracking. So that now led to that increase. Looking at the impact of the rebasing on other metrics, looking at public debt to GDP or current account deficit to GDP, by and large, it was muted. Unlike the 2014 GDP, whereby we saw a 25% increase in the 2030 nominal GDP, this time around it was quite 5% increase. And even comparing to other metrics, that led to some muted impact. Public debt, as at the third quarter, that is the latest numbers that we had pre the delay of the release of the economic data. We had, I think it was around 7.2 trillion, the overall public debt stock. So comparing to the GDP that was then, it was 68.5%. But now with the revised data, it just came down to 67%, just shaving off 150 basis points. Current account deficit, also prior, it was negative 4.9%. a marginal decline to negative 4.8%. So by and large, we are seeing that this time round, the rebasing didn't have an outside effect on other metrics. That's just our conclusion on that. The other thing that came out last week, basically in the CBK Weekly, which you didn't put in our presentation, was this impact of the SDR, special drawing rights. This is the currency by IMF, which by and large, I think it boosted the FX reserves, which ballooned by 800 million over the course of last week. So I suspect that is the direct effect of the SDR allocation now coming to our reserves, which now boosted it to around $9.6 billion, the FX reserves as at the end of last week. And yeah, so moving on to fixed income, last week we saw a slight interest in the secondary market activity that went up by 6% week on week to 11.5 billion. Most of the trades that were executed last week was on the infrastructure bonds segment. I think this is just investor positioning as they waited the results for the FXD1 2021, no, sorry, not FXD1, IFB1 2021-21. That was the infrastructure bond that was whose auction results came out last week. In terms of T-bills, we saw a slight dip in terms of the performance rates from 99.5% the previous week to 73%, which was an aggregate of 17 billion. That was the bids that came at the auction. Yields continued their uptrend, and it was more acute in the 364-day tenor, which went up by 26 basis points over the course of last week. Getting into the liquidity indicators, we are still in a high liquidity environment, as seen by the mop-ups by the CBK. That is the open market operations. The instrument that is used is now the term auction deposits. The bids that were received total 68.7 billion, and the bids that were accepted was 66.55 billion at a weighted average rate of 5.454%. On the other hand, interbank rates slightly edged higher by 29 basis points or 0.29% to an average of 3.63% over the course of last week. And looking at where we are in terms of net domestic borrowing, basically from the government securities, the T-bills and the T-bonds, so far we have, as per our calculations, we are at around 276 billion. That is roughly 42% of the target for the current financial year. So at this point in time, we are way ahead of the borrowing curve. I suspect that now Treasury CBK will sit pretty in terms of its aggressiveness or in the upcoming auction. So we're likely to see some longer tenor reopenings, but not some emergency that is being signaled in terms of the papers that will be on auction. So at this point in time, bottom line, we expect that there could be some relaxation from the Treasury, considering where they are at this point in time of the fiscal year. Looking at the results for the auction, we saw the target amount was 75 billion. The amount that was received was 151 billion. And at the bids that were accepted was 106.8 billion. So at a weighted, the weighted rate of accepted bids was 12.737%, and that is now the coupon rate for this particular issue. So secondary market of this paper starts tomorrow. Today's the value date. Tomorrow is now when secondary market activity starts on this particular paper. And that is now bringing us to the week's trade, where we are seeing most likely some interest in this on the run infrastructure bond paper. And we're likely to see that the yields will now come down slightly to 12.6 to 12.7%. The import now it will now start trading at a premium as this elevated demand on the paper comes in. This is on the backdrop also on the 44.5 billion that was rejected in last week's auction, which we'll see might most likely will be chasing to grab a piece of this issue. So that will also be an additional ammunition for the interest in this particular paper. And besides that, I think at 106.8 billion, this is the largest outstanding amount on any bond that you've seen. So the paper is liquid and also there is that interest. So that combination should be able to elevate interest in this particular paper. I think over the next 2 weeks, we'll be seeing massive interest in this particular paper. So let me stop there, invite my colleagues to walk us through the equities.
Good morning to you. The bourse was silent with announcements for the impending AGMs. That Centum, Scan Group, eGads, and Home Africa announced the AGM set for this month, with Express Kenyans coming in October. To be precise, Centum will have its AGM on the 24th of September. Home African Scan Group will be on 8th, and finally, Express Kenya will be held on 1st October. That said, the market was vibrant during the week, as signaled by the bounce back in the benchmark indices. The Nairobi All Share Index and the NSE 20 Share Index rose by 40 basis points and 1.9% week on week, respectively. Turnover grew marginally by 90 basis points week on week to settle at 2 billion. On the top group, Kenya Power, BOC Kenya, Sasini, and Kengen. Scan Group picked 20.09% week on week to settle at 5 shillings and 56 cents. The stellar run into the second week is on the back of the exoneration of the suspended senior management that boosts investor confidence. We hold the opinion that the rally will continue in the near term to the 2Q21 levels as investors accumulate on the earlier exited position. There's some news around Kplc hiring debt collectors to help recover dues that as of August last year, they were estimated at about 5 billion. And out of consensus view, this will likely see some excitement in the near term, and there being a high correlation, a strong correlation between Kplc and Kengen price function. Some of these will reflect on Kengen. Also, something to watch out on for is the IPP and the adoption of a local currency-based tariff for the PPAs, how that will span out. BK Group, IGAD, Olympia, Libya, and Sanlam closed the week as the top losers. Looking at foreign participation, foreigners accounted for 31.17% of the week's turnover. They turned bullish in the week, registering net inflows of 224.64 million. That's about a 216.4% week-on-week growth. They accumulated on Safaricom, Equity, KCB, and ABSA while exiting on EABL. Looking at the Sub-Saharan market performance, the Nairobi All Share Index outperformed its peers on a week-on-week median. The market price to earnings ratio was above the African median multiple of 11.5, while its dividend yield was below the median by about 190 basis points. The corporate calendar indicates that BOC Kenya's 1.5 cents, 1 shilling and 50 cents interim dividend and Centum's 33 cents full dividends book closure will be on the 24th of September and the 8th of October, respectively.
Thank you, Wesley. So I'll be taking you through the financial sector highlights. So just looking at the banking sector counters, the biggest laggard was BK Group. It saw its share price fall by about 17.2% week on week to 29 shillings and 80 cents. I think this might be due to the news that they didn't give an interim dividend. For DTB and Stanbic, it dropped marginally to close at 64 shillings and 89.25 shillings respectively. However, the other counters were relatively stable, with equity going up 3.7% to 51 shillings and NCBA up 2.2% week on week to 27 shillings and 60 cents. For the insurance sector, Liberty, Sanlam, and Jubilee dropped 7.7%, 5.5%, and 1.6% week on week, respectively, to close at 7.64, 9.92, and 359.25 shillings, respectively. So the rest of the counters were relatively stable. CIC was up just marginally by 1% week on week to close at 2 shillings and 80 cents. So looking at what has been happening in the market, so CBK released some data on the number of ATMs as well as mobile money. So the number of ATM machines has gone down to 2,393, according to the latest figures that's in July, which is the lowest since July 2013. So maybe this can be attributed to the growing popularity of agents, internet banking and mobile banking, as customers now are more into convenience. So the transactions for electronic cards actually went up by 100 to 434 billion from 334 billion the same period last year. The number of agents now actually has gone up by almost 30%. So it just goes to show the demand for outlets in the country. And also after the government had implemented the directive for push of cashless payments to stop the spread of COVID, this also boosted the number of transactions. And now customers have they have expressed more interest in mobile money. So we're going to see more banks increasing their digitization efforts as they have. We've seen ABSA has released its ABI platform, the WhatsApp banking platform. So we're going to continue seeing banks putting some more effort in the digitization of their mobile transactions. So also this is supposed to have, hopefully, a positive impact on Safaricom's revenue as the number of transactions grow. So for the commercial lending rates, it went up to 12.09% in July. So this is the highest it's been since March of 2020. And so it's just pointing to the potential that it might go up in the future as the economy recovers. So it's expected that this rise is marginal, so it shouldn't affect households immediately, but as the economy grows and demand for credit goes up, it's expected that it will rebound. So just a note that this lending rate is purely the interest banks charge on loans, and it's not inclusive of the charges, that's the excise duty and the fees and commissions. So looking at the financial sector reports. So this is a report that is released by the market regulators in the financial market. So that's the CBK, the CMA, IRA, RBA, and SASRA. That's for SACCOs. So the report noted that the financial sector is stable and it's resilient to deal with the COVID-19 shocks. We've seen there's been strong performance, like we've seen the bank performance, they've been reporting good profits. Also, there's robust regulatory and supervisory oversight and policy measures. So banks are expected to remain stable, mostly supported by capital and liquidity buffers. However, microfinance banks are expected to remain a bit vulnerable, mainly due to competition from other credit providers, and also microfinance banks usually operate in a niche market. So there's been a negative impact on that. So for capital markets, it faces flight of safety by investors. That's creating more volatility as well as reducing liquidity. However, we've seen that for this first first half of 2021, it's been showing some signs of recovery. So we'll wait and see what happens in the second half of the year. Insurance sector have been facing declining returns on investments as gross premiums grow. However, we've seen also they've been posting better performance in the first half results. Pension sector, mostly due to falling member contributions after people lost their jobs, as well as withdrawing their pensions early. So those are the factors that are affecting the market. So looking at I&M, so they want to add capital to the recently acquired Orient Bank. So they want to add about $5 million to boost the capital. And they also set to now start the rebranding exercise, which is supposed to be completed either by the end of Q3 or early Q4. So the final cost of the acquisition will actually be known after the completion of an audit, which is ongoing. And this price may go upwards because of the appreciation of the Uganda shilling against the dollar, also the short-term performance of the subsidiary and the sale of property. So like the group had also mentioned that they want to broaden its wealth management services, and they want to launch a money market fund in October next month. So they also started trading bonds and other sovereign bonds. They're also looking to introduce offshore investments that will give clients access to exchange-traded funds, indices, and shares in other stock exchanges that will help them to diversify from the Kenyan markets. And then lastly, the insurance sector net profits went up by about 136% in the first half of 2021. That's according to a report released by IRA, that's the Insurance Regulatory Authority. So the profits went up mostly due to higher investment income and growth in gross premiums. However, there's also been a rise in claims that has gone up 29%, mainly due to now the economy coming back, businesses recovering, and also people going to the hospital more. And as I said before, like the retrenched employees are cashing out their pensions early, and also people have opted to terminate their policies early so that they can save on money. For the trading idea of the week, it's a long-term buy on Kenya Re. So the counter has been trading in a deep discount. That's a price to book value of 0.2 versus the industry median of 0.8. So the market price of 2.52 shillings is still at a discount of the net cash per share. And also Kenya Re gets compulsory concessions from other insurers. So that's a source of income for them, and also the national insurer. Also because of the government stakeholding in the company, it's expected that dividends will continue being paid, as that's the source of revenue for the government as well. I think that I can end there. Back to you, Churchill.
Thanks, Melody. Thanks, Wes. I think we have come to a close of our formal presentation. Over to you, Dan.
Yeah, thank you, Churchill. So maybe now we can go to the Q&A section. If you can still send in your questions, as we'll be tackling them as they come by. Elvis Ayara has 3 questions, and I think maybe you can start with, there is talk in town that Equity Bank appears to be a one-man show, that is Dr. James Mwangi. Are we going to see their shares decline in any case he resigns? Maybe Churchill, you can handle this. Or Mel, sorry. Melody.
I can try and tackle this. There's that issue of the kingman risk in case something happens to Dr. James Mwangi, but they say that they've made some changes to the management, the top level management, so that this does not happen. So we'll just have to wait and see but they've said that they've put some measures in place so that there's that diversification of power.
Okay, thank you. The second question, I need advice on Absa shares. Are they likely to rise to something like 16?
So well, from the recent valuation that we did, it was coming to about 11 shillings and 90 cents thereabout. So maybe in the long run, it could get there, but it all depends on the digitization efforts as well as the management of the NPL book, the non-performing loans as well. Though we've seen that it has one of the lowest NPL numbers in the industry. So we'll just have to wait and see what strategies they have come up with. So in the short term, I believe it's going to be at around 11 shillings and 90 cents, but we'll just have to wait and see what they come up with a strategy to see if it will push it up to the levels of 16 shillings.
Okay, the third question, Unga Group recently announced a new managing director. Is that likely to affect its operation?
Let me take that one. Nick Hutchinson is expected to play an advisory role for a time to facilitate a smooth transition after his retirement. That said, the incoming Joseph Malel has quite an experience in food and beverage manufacturing, given he's coming from Peptang. That was a direct question, and this is my direct answer. I don't see a drastic change in operation.
Okay. One more question. There's the fuel prices are about to be announced on 15th of September. What is the likely impact on the stock market, given that it might go up or remain as it is?
Interesting question. Let me take that one. I think, well, looking at fuel inflation or the impact of fuel pump price, whether there's an increase or a decrease, direct correlation to the equities, we haven't seen that much like one-to-one correlation when prices go up, fuel inflation goes up, and then spilling it over to some of the counters in the capital markets. I think a function to that could be if you look at our capital markets, it's heavily tilted towards telco, which I think is 60% market cap, and then banks another 20%. So over 80% of that is now in two different sectors that may not have that fuel inflation or fuel as one of its major components. So that could be it. But now specifically, perhaps you could get into, say, Total's margins. It will be a factor in, say, Total Energy's fundamentals of the company itself. So keeping an eye on that, but I don't think there's that direct correlation to the equities markets, depending on whichever route it goes, unless if there's an unsustainable upward trend in the fuel pump prices. Of course, that will have an impact in the disposable income in the economy, and that will negatively impact even the fundamentals of some of these companies that rely on their consumers to go to them. But at the moment, I don't think that impact is that outsized as the question might try to suggest.
Okay, Henry Matere is asking, what stocks would you recommend for an income investor?
I would say this the stocks that traditionally pay dividends. Those are like KCB Group, Standard Chartered Bank. However, like if you are to go to the tea industry, those stocks are a bit illiquid. That's Kapchorwa and Williamson Tea. They also pay dividends. However, there's the aspect of liquidity issues. So for me, I'd say just basically the companies that pay dividends. So we saw, however, Absa usually used to pay dividends and equity. However, they had withheld it during the period because of the COVID pandemic, but Equity has also announced that it's going to resume dividend payments. So that's another source that's another counter that investors can look at. Churchill, might you have something to add?
Okay, Melody, Jared is asking you to say something about Kplc shares.
Well, for Kplc, there's a lot going on with the counter. We saw that actually the ESCC has summoned some of the directors to go for questioning about the procurement process. So there's still some issues. We've also seen they now have to get debt collectors to actually collect on the outstanding bills. Also, the issue with the payment purchasing agreements that are seen to be quite pricey. So for the moment, until they have all those issues sorted out, I say that's just a bit of caution on Kplc. We know that as part of the requirements for the World Bank loan, those are supposed to be reforms. So we're just going to wait and see how that comes about.
Thank you. Kamau is asking, the economic survey showed growth in logistics and transport, but Express Kenya is still illiquid. Why?
Oh, that's an interesting question. I didn't even thought about it that way. But ideally, if you look at, and I think I may be wrong, but the transport sector, it's transport and storage sector for last year, I think it collapsed because of what happened last year. The containment measures that were there, lack of, or reduced travel. I think even the number that caught my eye, that there was a 62% or 65% drop in air passengers over the course of last year. So that had an impact in the overall sector, and like an increase in the transport and logistics sector. But that said, I think the fundamentals, it now boils down to the fundamentals of Express Kenya. We haven't critically looked at that sector. So this is just some high-level thinking. The economic survey, how they track that, you're looking at land, you're looking at air, you're looking at water. So that is the component of the broad transport sector. But if you go to the Express Kenya's counter, you find that it's just playing in a small space out of that aggregate. So it now gets down to perhaps it's not competitive enough against its competitors, or even the space that it's playing is not that it's not that favorable at this point in time. But I think my teammates will be able to look at that nexus between the overall transport sector and the company, Express Kenya, and then you can be able to give an elaborate view to not Jared, this is Kamau.
Okay, thank you very much, Churchill. Willie Onyancha is asking, do you recommend Centum counter in the short term?
Well, given their unrealized gains and how they will be accounted for in this and the next coming years, and even how the company is going on forth, for a speculative buy, it will work for the counter.
Okay. There's no other question. So thank you very much, Churchill, Wesley, and Melody for the presentations today. And to you, the participants, we thank you for setting apart this time to attend this webinar and getting updates from our team. And should you want to buy or sell shares, you can do so via your mobile phone via our application called Jikuze, which is available both on the Google Play Store and Apple Store. You download and get started. Okay, over to you, Churchill, for the last one.
Well, there's, before I go there, there's a question that George Macquarie had raised last time. And if I remember correctly, it was around the auction. I don't know the specific question, but it was around the auction for the treasury bonds. So perhaps just to bring everyone on board, assuming there are 5 investors who want to place their bid. So Investor Churchill, assuming we all place 20 billion, 5 of us. So Churchill bids at 12%. We have Melody 12.25%. We have Wesley 12.5%. Dan 12.75%, and then we have Damaris at 13%. So 5 investors all bidding in an increment of 25 basis points, 0.25%. So the average for that auction, if you average it out, is coming to a weighted average of the bids that came at 12.5%. So that is similar to even the IFB that was there last week, which was around 12.8%. And then there's usually a cutoff. It's a bid that we don't know about. It's either predetermined before the auction or once the bids have come in, and then they have a bid, a cutoff bid. So perhaps this cutoff bid is 12.70. So that means that Dan's bid at 12.75% and Damaris bid at 13% are rejected. So remaining with the 3 bids, mine at 12%, with Melody's at 12.25%, and then Wesley's at 12.5%. And then you do the average of these 3 bids, it's coming to 12.25%, from the initial 12.5% to 12.25%. So I think that's how the bidding comes about. And it's I don't know the specific name of which bid auction it is, whether it's a Dutch auction, whether it's different auctions that are out there. But I know that the nitty-gritty is the bolts and nuts of the auction. That is what happens. There's a cutoff, and then there's the average bids of accepted bids and the market-weighted average rates of bids. But the specific auction name, it's lost to me at this point in time. So that's a question that I remembered. Anyway, so some personal news that I want to let you know. This is my last Genghis Weekly Investor Briefing. I'm transitioning into a role outside Genghis Capital. It's usually an interesting time just having these discussions with all of you. It just makes us think wider as research team. And I know that this product is not just a research product. We collaborate with the marketing team, other colleagues of us. Perhaps you've never met them in the dealing team, in other places. So they make us be who we are in the weekly investor briefing. So it's now, as I transition into a role, I wish you all the best, you participants. I think we've become a family. I usually tell other people that I connect with some of you because I interact with a number of you on a weekly basis, more than even I connect with some of our colleagues because of this working from home issue, working from home environment. So you guys have been a family. I'll miss you, but I know that Wesley and Melody will be able to take it over from the research perspective, research side. From marketing, we have Damaris, Dan, and also Dora, who also play a role. Yeah, let me stop there. I'm seeing so many chats coming up, but much appreciated. It's been real.
Good morning, everyone, and good morning, Churchill. We're glad it's been real. I think as we say goodbye to you, let me quote, I never quote books, that's you, but let me quote William Shakespeare by saying that parting is such sweet sorrow. It's been amazing the past, I think we've been doing this for a year, for just about a year now. So it's been great collaborating with you and your team. This is something marketing really enjoys doing, and you really did add that extra sparkle. So we're going to miss you, but we know that Melody and Wesley are very capable, and they have been easing into this role. So Melody and Wesley, we're super excited to see you morph into something bigger than yourselves, and we're here for the support. So Churchill, let me echo everyone's sentiments from Nelson to Christy to Koech, who wish you the very best in your new role. And you know how people say, Nairobi is small, so we shall cross paths again. So all the best.
Thanks. I hope that if I bump into any of the participants, they'll be able to get me coffee somehow. I've never met some of them. I don't know if there'll be a chance where we can have an audience, we can have one big family. I don't know whether they can be given that opportunity, because just to put a face to their names. But nonetheless, it's been an interesting ride, and I hope to interact further with other people, whichever spheres it will be.
Sawa. All right, Daniel, back to you.
Okay, thank you very much. And thank you everyone for attending today's webinar. Let's see you next week.